Hello, everybody, and thank you for joining us for another episode of the Financial Commute. I'm Chris Galeski, your host, joined by partner and wealth advisor Bruce Tyson. Bruce?
Good afternoon.
We were having a fun conversation about the markets, about modern monetary theory,
Right.
the debt ceiling, so many different things that come into play when it comes to investing. And it made you think of a number of instances that we have seen in history before that, free money or just wacky things happen when
Right.
valuations kind of get out of control.
Right. So many years ago, I read a book called, and I have it here with me, Extraordinary Popular Delusions and the Madness of Crowds, written by Charles Mackay in 1841.
Wow.
So it's been around a long time, and there were many financial bubbles before then. And this one has a foreword by Bernard Baruch, the legendary investor from the first part of the 20th century. And he says that this book saved him millions of dollars.
Really?
Yeah, and he's a smart investor. So it made sense to look into the book. And I just found so many fascinating parallels between today and things happening hundreds of years ago.
So let's put that into context, why there might be parallels. If you rewind maybe 20 something years ago, the US maybe had a small deficit, smaller deficit.
Yeah.
But then you fast forward over, 22, 23 years, we had the great financial crisis, we had COVID, we had 0% interest rates. And now all of a sudden the US has $30 trillion worth of debt.
Right.
But it's not just the US, it's globally.
Right.
So all of this money is now in the system, and it creates sort of asset bubbles or...
Right. So there was one of the bubbles is referred to as John Law, who was a Scotsman, well-versed in finance, and John Law and the Mississippi Scheme. And he, it's a long story, but he went to France, and he was talking to the regent of France. The next king was too young, so there was a regent, and the regent didn't know anything about finance, but John Law showed him that you could issue notes backed by real estate or by taxes, and this was good. That was a good way to get some paper money into the system because they weren't using paper money; they were using coins. And the problem was every few years the state would devalue the coins, and they would have you turn in one set and issue smaller ones, less gold, less silver, and the populace was upset. And then there were other banknotes issued by the prior king. That was King Louis XIV, who was very extravagant. I think he did Versailles. Right?
Yeah, Palace Versailles, yeah. Which is an amazing place.
Spent a lot of money. And so the populace, was upset with all the spending. And so they were looking for a new way to do things. And so John Law suggested this method of doing paper money. And what happened was that the regent liked it so much that where John Law wanted 60 million, of the currency floated, then the regent said, let's just do 500 million.
Wow.
And then it got bigger and bigger, and so again the finances were became a problem. But because at first it worked really well, just like our systems. It seems to be working pretty well. But then, so one of the things, because it was working so well, John Law asked for the rights to get trading rights to Mississippi, and he was talking about all the gold that you can find in Louisiana, and so this is the Mississippi Scheme. And then people went, it was a feeding frenzy now because there's all this money out there because of the printing of the money, and they were just running up the cost of every share, and they were issuing more and more shares, and there was nothing, there was no assets.
Nothing tangible.
Back it up. It was what the profits were going to be when the Mississippi Scheme worked.
Yeah.
And of course, it never really got off the ground. So that was some kind of ruination, and that was something that.
And that's one of the first iterations of maybe modern monetary theory. And so some of the trials and tribulations that we face today, when interest rates are zero, you can borrow and print as much as you want.
Right.
But eventually you're going to have to pay that back or figure something out. But
Right.
while the money's out there in the system, it's got to go somewhere, and it's creating asset bubbles, whether
Asset
it be
bubbles, right.
real estate or stocks or crypto, or even companies that we call zombie companies that don't
Right.
have any earnings.
So one of the things that happened is that because there's such a feeding frenzy for these shares that other people thought, hey, I can sell shares in something else that wasn't
Yeah.
particularly real.
Yeah. The silliness that happens from time to time when sort of expectations or money is kind of frivolous. That's a good example of a different type of zombie company. But as you and I discussed, we've lived through these types of things many times before.
Right.
You've got kind of what's going on in the markets right now, where these zombie companies or companies that aren't profitable have been able to borrow money and stay afloat for so long. Now that their interest or borrowing costs are expensive, they're struggling, or maybe have come down a lot in price. We lived through it maybe a little bit in the financial crisis and
Right.
how much risk banks had, and then obviously in the tech bubble back in the late 90s.
Right. So with interest rates higher, these zombie companies are really going to have to figure out a new way.
Yeah.
Or they're just going to have to close up shop. The zombie companies, there's an actual definition of zombie companies. It's that the earnings don't pay for the debt service.
Yeah.
At some point, the lines cross and there's no more. There's no value in the company.
I think that as an investor, a finance professional, and somebody that talks to people about money for a living, I think that's the hardest concept for people to completely understand, right? Because if you're a person and you don't make enough money to pay your debt, or even just the interest on your debt, like you file for bankruptcy, there's consequences.
Right.
But then somehow there's these companies, and sometimes they are brands that we touch and feel, or there's our government that does not have to operate by the same rules for a long period of time. It's really hard to comprehend.
Right. So there's an old saying that if you can't pay back the bank $1,000, you've got a problem. But if you can't pay back the bank $100 million, the bank's got a problem.
Right.
And they want to work with you to solve that problem.
The too big to fail. One of the most famous sort of bubbles in history is the tulip crisis,
Right, the tulip
tulip
crisis.
mania.
So tulips were originally, I think, discovered in Kazakhstan, and they made their way to the Sultan Suleiman in the Ottoman Empire. And tulip comes from the word turban. And so anyway, he gave them as a gift to the Viennese ambassador, who then somehow made its way to Amsterdam, and that was a shiny new toy. And the fashion was everybody had to have it. This was like in the 1600s, and there was a new mercantile class, and there was more money, from trade. Amsterdam was a big trading center, and they had more money. So the schemes were amazing, and they're just some crazy numbers. It was just extraordinary. And then one day it stops.
Yeah.
Music stops playing. And one of the things that points that Bernard Baruch makes in the forward is that the book made him think about 2 and 2 is still 4. And as investors here, we're looking at markets over the last the last 5 years or so, 10 years, and prices got so high, and the 2 and 2 factor comes in when we think, okay, company has this amount of earnings,
Yep.
and this amount of shares, and what's a fair price to pay? And we keep going back to what's a fair price to pay, and these companies were just in this last 10 years, so many of them, there was no real rationality for those numbers.
It's a difficult thing. I mean, if you just look at the competing forces, the last, call it 12, 15 years, as interest rates have been zero, now they're not. The Fed's trying to combat inflation, they're raising rates, but for a long period of time, interest rates were all-time lows.
Right.
So you had the dividend yield on the S&P 500, maybe close to 2%,
Right.
and you had the interest on a 10-year treasury, one of the safest things to invest in at the time, was
Less than
at
1%.
2% or even lower,
Yeah.
right? Or even
1%.
much lower
Yeah.
than that. And so as an investor, The only way you lose is if 10 years later, the S&P 500 is worth less than it is today, but you're going to collect more income along the way.
Right.
And so it just forced so many people to kind of go out there. And so when we're looking at investing today, we're not saying don't take on risk. You've got to take on risk to get growth, but be mindful of the risk that you're taking on. And there are some really attractive opportunities that don't carry on as much downside risk as maybe stocks or some other assets, right?
So now you can easily get 5% in safe investments, and that's less competition for stocks. So a lot of, say, big pension funds who their bogey is typically making 7%, so they can make 7% with some little bit more aggressive bonds, but they can achieve their objectives of 7% without having to buy stocks. So the demand for stocks will be less than it was before.
Yeah, it makes sense. Bruce, thank you for coming on and talking today about a number of crisis or certain bubbles that we've experienced many times in the past, and other ways that we can help protect ourselves.
Yeah,
really appreciate it.
Good. Glad to be here.